It's a perfect lead-in to our next speaker. Brett is going to be talking about capital gains deferral solutions. I know we heard earlier from Ray DeWitt on DSTs, because we all got hypnotized by him by standing up and saying DST, Ray, right? So, and I would like to invite Brett up to the stage. He's done over $500 million worth of transactions in this space, and let's all give him a round of applause. Thank you.
All right, hello everybody. Imagine, if you will, it's 2008 all over again, and the financial turmoil is happening all around you. It's a time when the world kind of stands still, faced with the most severe economic crash since the Great Depression. Now picture yourself as an investor glued to the screens as you watch stocks plummet, retirement funds evaporate, and your 1031 dreams crumble. Your confidence wavers, your hands shake as you grapple with the fear and uncertainty of your financial future. Banks are collapsing. Real estate, once a safe harbor, is now sinking beneath waves of foreclosure notices, and the value of your properties are tumbling. And panic starts to set in, and you start wondering about your investment thesis and or just, if that 1031 exchange is going to make a lot of sense moving forward. Well, you're not alone. Investors everywhere are desperate at this time. They're hungry for a strategy, a lifeline, a glimmer of hope amidst the financial ruins. But now, fast forward to today, and we're on the brink of another potential financial evolution, yet we're armed with the wisdom gleaned from today's talks from many amazing individuals who have years and years of experience through multiple downturns and different strategies to implement over a course of a, perhaps big opportunity coming up. As well, we've gleaned experiences and lessons from the 2008 crash. And that's why we're here today, to discuss the importance of constructing a robust capital gains tax and estate tax exit plan with your investors, a blueprint for survival, growth, resilience, and impact, a strategy to raise more capital even when the storm clouds gather. So let's talk about how to raise capital by solving your investors' capital gains tax problems. We're also going to mix in estate tax challenges as well. So how do you raise capital gains tax by solving your investors' capital gains tax problems? Well, first of all, you understand what the problem is. I don't know how many of you guys saw in the WOVA app, but I asked a question. I said, hey, what does the $84 trillion mean to you? What does that number mean to you? Does anyone know what $84 trillion means to America, to us, to all of us? We can talk about that here in a minute, but thinking about that, $84 trillion. In fact, it's about $32 trillion of debt in the U.S., which is a big number, but think about $84 trillion. Well, we had I think it was James, talked about skate where the puck is going. I want to encourage you to think about that $84 trillion number as we're talking about capital gains tax planning, as well as estate tax planning here in the next few minutes. So where do you think capital is going? Or a better way to think about it is, where's capital coming from? Well, where do most of your capital come from when you're raising it? Is it coming from, of course, existing investors, perhaps? Perhaps they're selling some kind of highly appreciated asset. Is it coming from their retirement account? Is it coming from their business they sold? Where is it coming from? How are you tracking that? And how are you helping your investors be ahead of the curve when it comes to exiting, but might be their biggest exit of their lifetime as well, might be the biggest opportunity for them to make the biggest impact with their wealth for their family and for the things they believe in most, but also for your company to be able to invest with you or alongside of you, so you can also create and preserve more wealth with them. So the answer that I found for most of what we've practiced here with capital gains tax solutions is highly appreciated assets. In fact, there's some really key stats that I'd like you to consider. But before we go there, here are some of the ones that you may or may not be thinking about. Cryptocurrency is starting to make its comeback now. We'll see what happens with that. I'm more into real estate, but also love for people to be able to exit at optimal timing. And so we're seeing a lot of exits that are going to be coming with crypto, NFTs, businesses, of course, investment, real estate. Perhaps you have people that are calling you want to do a 1031 exchange into your fund, but you're turning that money away, you're turning that capital away. Perhaps there's people who are wanting to maybe even do a Delaware statutory trust, but they're past that 45-day identification and they're running out of time. Maybe it's GP or LP interest that you're exiting out of business ventures or real estate ventures or different funds. Or maybe it's that big primary home in Palo Alto or La Jolla or New York that you've owned or your parents or your family has owned for 20 or 30 years, but they're not selling because they don't have a great 1031 option. Maybe it's that private or public stock. Maybe it's carried interest, captive insurance. Maybe it's artwork or collectibles. Well, here's some key stats that maybe you want to take a picture of. And this is why I believe right now is the best time to go all in on helping your investors know about, be educated in, capital gains tax and estate tax solutions. And here's the big problem that we're facing. $84 trillion over the next 18 years is the number to think about. And I'm coining this or thinking about this kind of like the reverse Tea Party, right? What happened when America broke away from the holds of Britain, right? Not enough representation for the taxes we were paying, right? We were even a country yet, right? And we're figuring out ways to build wealth in a way that opened up freedom and opportunity for friends and family and everything that was during those times, right? And so now, fast forward, 200 plus years later, I feel like it's the reverse Tea Party happening over the next 18 years because there's more wealth that's set to transfer from one generation to the next in the next 18 or so years. By 2045, according to Marcus and Millichap, John Chang, about $84 trillion will transfer from essentially the baby boomers to the millennials. And this is known as the largest wealth transfer in the history of the planet. And in fact, 77 million baby boomers in the US alone, and about 10,000 are turning 65 every single day. And how many of you know that 50% of the total net worth in America is tied to really three asset types? It's private equity, known as businesses, commercial real estate, and primary homes. And those three asset classes represent a massive amount of wealth that most of the baby boomers own, and it's also highly appreciated, of which they typically want to sell, retire. Maybe they feel real estate rich and cash flow light. Maybe they are retiring from their business ventures. Maybe they're doing something else besides just building wealth. They're looking for ways to preserve it, but also create it at what we call optimal timing. And so we're going to spend the next 5 minutes diving into three main things, which is what is the most effective way to solve your investors' capital gains tax problems. And by the way, I'm not a CPA nor tax attorney. I do work with a business partner of mine who is. I'm just a grew up in a real estate family, building houses in the Bay Area, California. Had a fortunate opportunity to study and practice multifamily brokerage at a place called Marcus and Millichap, doing lots of 1031 exchanges and helping people buy and sell, mostly multifamily properties. But I fell in love with the 1031 exchange like most people do. But guess what? It let me down. It let our clients down. In the between 2008 and 2011, it let us down. A lot of challenges happened and a lot of pain. And so the thing I want you to write down is pain plus reflection equals progress. In fact, this is a quote or a formula by Ray Dalio. Pain plus reflection equals progress. I was able to connect the pain of the 2008 crash, and hopefully you were feeling a little bit of that on the intro here, with a unique skill set that I've developed, learning from some really smart people with capital gains tax solutions. And now my vision is to help, hopefully, inspire some of you to take some of that same pain that you may have experienced and or some of your investors have, reflect on what happened and what can be different in the future. And I think that can help you raise more capital, okay? And it really does three things when you can do that. You can provide a solution that provides financial freedom, provides personal freedom, and the impact that your investors desire. So what's an effective capital gains tax exit plan financially speaking? Well, I think it does a number one thing that oftentimes the 1031 exchange does not do. It does not, an effective capital gains tax plan works for all assets of any kind: cryptocurrency, primary homes, businesses, carried interest, captive insurance. It can also go into other asset types, into funds, the investments themselves, all tax deferred. In other words, it gives you freedom and flexibility to make decisions. The biggest challenge with the crash, either a crypto crash or a real estate crash or different things that are changing, is the ability to make decisions at optimal timing. And so you want something that's going to give you that tax deferral and it's going to give you that optimal timing. The next thing is investment opportunities kind of fits into the I'm sorry, the first one is, and then you pay taxes, you receive payments back, okay? But the second one is investment opportunities. You want to have what's called optimal timing. Who's ever been in a 1031 exchange with the hair on fire, 45 days to identify? We call this the shotgun wedding, 180 days to get married. And or your investors call and you just have to turn them away because guess what? Unfortunately, your fund does not accept 1031 exchange dollars, right? Or the asset they're selling is not even 1031 eligible. So that's why you want options for investments. The next one would be just flexible payment structure and tax flow optimization. How many of you know the government has a spending problem, which means we all have a tax problem? And this has to do with income tax and capital gains tax and estate tax. How many of you know that estate tax is not solved by the stepped-up basis? We've been taught, and when I was married to the 1031 exchange, we've been taught that the swap until you drop is the best way to build wealth in commercial real estate. Well, guess what? It's a great way to defer capital gains tax and get a stepped-up basis if that's still around by the time we all pass away. However, it doesn't solve the estate tax challenge. And the estate tax challenge is over 40% of your net worth if you're 24 million married, 12 million single, set to cut in half in 2026. We call it the government's biggest mousetrap. So you want something that's going to be tax optimized, okay? So how do you do that? Well, financially, you want something that can defer up to 100% of your capital gains tax, eliminate 100% of your estate tax, eliminate the need for the 1031 exchange, and or just be a backup plan. Because if you find a great 1031 exchange, fantastic. I love a 1031 exchange when the timing is right and you're buying the deal when it makes sense. Okay, but you also want something to be able to rescue it just in case it doesn't make sense. You also want to be able to gain a fresh depreciation schedule. Depreciation is one of our biggest allies when it comes to growing wealth because it can offset the cash flow. We call that tax flow optimization. You also want something that gives you asset protection and debt freedom. All right, so what's effective capital gains tax exit plan when it comes to personal impact? Well, we found that a lot of investors for the deals that we've raised for, they want a number of things, just a few of them here. Time freedom, partnership freedom, location freedom, short-term or long-term gains, right? Not having to hold it for more than a year. A passive cash flow freedom, but also entrepreneurial freedom. They want the opportunity to go back into their own deals at their own timing if and when it makes sense with themselves or with their partner. So an effective capital gains tax plan is going to give someone the freedom they desire, whether it be passive or active. So, wrapping it up, if anyone's seen the movie Meet Joe Black, if you remember this scene, it's death and taxes, and this is a billionaire, Anthony Hopkins, and death represents Brad Pitt here. And there's nothing to be, there's two things in life we can be certain of, death and taxes. However, we have an opportunity to make an impact and help people when it comes to these two things with estate tax and capital gains tax. And so if you want to learn more, I wrote a book with a couple cool people, really smart people I got in the room with, got a book with, so you can check that out. Other than that, happy to answer any questions for anybody.
All right, great. Well, we have cocktails coming up after just another 3-4 speakers here, so I'm sure we'll be able to find Brett and ask questions as needed later. Thank you. Great job.